This afternoon, we have Sanjay Parekh, founder and CIO at Sohum Asset Managers. Hi, Sanjay. Good afternoon. What's going on? No sign of Santa. Santa is, making an entry and exit very quickly. The bulls are hoping that he stays longer, but that's not the case. How are you feeling about the markets? I mean, towards the end of the year, what is the cash levels you're sitting on and deploying or not?
Yeah, so Nigel, good afternoon. So basically, I think a bit of global uncertainty, a bit of dollars being stronger, and hence EM currency being weaker. But I think the most important is the earnings season. I think as we enter into the Q3 earnings season, we've seen Q1 and Q2 quite weak. And as we see sectorally and engage with companies, we think Q3 will also be quite tepid. And hence, we will have to look for signals of recovery in Q4, hopefully when the government spend picks up. Because the government spend is just at the last leg of Q3 is where they've started to spend. It's still not broad-based. You saw that in Siemens commentary as well. And certainly we are seeing on the rural piece also, FMCG players are talking about still a prolonged slowdown. So it's going to be a weak quarter is what I understand, and hence market will pause or react as well. But I think more so the time correction is what I see from here. I think the price correction by and large we are done.
Okay, time correction is what we will see. Price correction is largely done. Sanjay, good afternoon. Good to see you back on the program. Prashant here. So talk to us about what you are really convinced about. Let's take one or two stocks as examples.
I mean, we still have that same domestic overweight and global. I mean, globally, we've reduced our underweight, which was there in technology, and but still we are underweight. Of course, we got hit in the last 3-4 months, but the stock selection helped, like Infosys and HCL Tech helped us. Pharma, we are mild overweight. We're not there in oil and gas or FMCG. FMCG, we still feel that growth is going to be quite tepid, and valuations are still stretched. And the rest of domestic, like auto, we are mild overweight. Financials, we are overweight. Banking, mild overweight. Telecom, we are overweight. Capital goods, we are overweight. So overall, our portfolio basis, we are comfortable because the valuations are reasonable. Our portfolio price earning is 15.7 times for growth rate of 19% and ROEs of 17%. So we are fine. Having said that, I still feel that the earnings season being weaker will also hit to some of our holdings. Like in banking, what we hear is credit growth we've seen is 10.6%. It will reflect in earnings. And there is definitely some edge, some increase in credit cost because of personal loan and credit card. And of course, those who are exposed to MFI will be largely impacted. So we're going to have even a weak season in banking financials also is what I think is what.
So what's the cash level now, Sanjay?
It's 7%, right?
7%. And what about investments in new age tech companies or any of the new IPOs? Have you been deploying there?
New IPOs, I mean, there's certainly some of them are good, but at the point they get listed, we feel at least that they're quite euphoric on valuation, and our style is not where we would be overpaying for growth, and that conservatism sometimes hit you also. So we've not been very active in we're there in few of them, but not a lot of them we not participated.
IPOs you participated in?
Yeah, so we did own a little bit of Vari earlier, but we sold it. And other than that, we do look for, I mean, you see the oversubscription levels. So even allotment as a fund, we don't get much if we apply, unless it's in anchor. So we've not been very active. We watch and we very closely look at it, but some of them are really at a steep premium to our assessment of value. We're not able to participate actively. And then we do compare, while there are two markets at times, what we feel is the listed existing segment and the new IPOs, which are like what we call in the Hindi, a new Nai Dulhan, where like they're genuinely priced very, very differently. So then we are comfortable with our own stocks and we hold on when we compare with our existing portfolio. In fact, some of the larger caps are very, very reasonable than some of these listings. So then we are okay. And luckily, performance is on our side, so we can afford to miss out.
Okay, all right. Sanjay, I wanted your view on one of those stocks. Towards the end of 2023, people were wondering whether Mr. Agarwal is going to default or not. And in 2024, Vedanta actually has been the stock of the year. The stock, I think, has given 80-85% returns. It's also thrown in that token 43 rupees of dividend. 43 rupees of dividend on a stock price of around 260 rupees. I think you all were playing out that theme as well. Do you believe there's more juice in this stock?
Right. So, here is where, you all have also covered it so well, taking his interview. And here was, we were really lucky to have added way down. And then we actually increased at all levels because we get money at a different point of time. And, as early as just 5-7% lower also we've added. And as you rightly said, your entry point also helps you. And then you get a dividend of 43 rupees. The global parent debt has significantly reduced. The cost of debt, as you all know, is in dollar terms is almost less than 10%. And you'll see it getting better and better. So once that happens, the entire overhang, which was a worry for a lot of investors that the parent debt could someday spill over in some way to the listed company, is clearly the parent, the promoters have stood by what they said. And that confidence will further re-rate the stock is what we believe. And we genuinely believe from here also, there's a very good runway for growth. You'll have interim volatility in metal prices and hence the price volatility. But if you take a 2.5 year view, it could be a serious compounder from here as well. And the best part is the dividends will still flow through, at least in the next 2-3 years, because the parent still wants the debt to come down there to 3 billion and below. So we are very, very positive. We are overweight on this. In fact, this is the only metal stock we own.
Yeah, no, I was looking at your portfolio and you're saying that there's serious money to be made even from here. That's interesting to hear that.
I think
and that
even today you see
demerger, etc. has to happen. So,
Prashant, the demerger, as we see, we had Raymond's earlier. And whenever there is a demerger, there's some the combined piece was at 10,000 crore. Today, one of them is at 12,000 crores, the other one is at 12,000 crores. And this is a matter of just not even 12 months, So here again, I believe that as the companies get focused, and they have been very clear of where the debt would reside. And some of the businesses like aluminum and can be very, very good. And then investors can decide where they want to be. But these splits generally have created a lot of value. But apart from that, I think the debt management at the global level was the biggest hangover, which will re-rate into, if you take the metal, some of the ferrous companies, on lower EBITDA per ton, they're at 7.5 times, some of them at 8 times. Here today also, I think even in the current price, the implied valuation will not be more than 5 times. So there is a very clear scope of re-rating, even if it is at 6.5 times. And then split would have more focused companies. And that would again add down and create value. And then dividends would be an add-on. So I think it's a real good deleveraging story at the parent level. And even at the India level, in the listed segment also, they have said that they will deliver. And one of the worry was if they would take up some of these semiconductor projects in the listed play. I think that also they have denied. So I think, as the confidence builds up, there could be a serious compounding even from here on at Vedanta.
All right. Thanks very much, Sanjay, for joining us. Good chat. And if you don't speak again,
have a great year.
Happy holidays. And absolutely. Thank you so much. And to you too and your team. Well, let's focus on D Street chatter now. Nimesh is joining us with exactly that. But before that, I have to just make a quick mention of the market. There was some recovery actually. Now